Hello guys, today we're going to talk about three very popular indicators that were created by Wells Wilder. These indicators are the directional movement system, parabolic SAR, and the RSI. I'm going to show you how to draw conclusions from these indicators and how to use them correctly in your trading by giving you some trading example and tell you what you need to be careful. I'm not going to be going into the formulas of the indicators because I don't want to confuse you. It's very easy to find these formulas on the internet. The first indicator that I'm going to talk about is the directional movement system. This indicator is a trend indicator and is supposed to show you the strength of the trend and also to give you trading signals. Just you need to be careful that in order to trade the directional movement system successfully, you need to be trading it in a trend. So you need to be confirming it with higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. If you're not trading an indicator in a trend, probably you're going to get a lot of failed signals. Let's go to cTrader where I'm going to show you how a directional movement system indicator looks like. So here we have a Euro USD chart with a nice uptrend, and I've plotted a directional movement system. The directional movement system plots three lines. The first line is called the plus directional movement line. The red line is called the minus directional movement line, and the blue line is a famous ADX indicator, which is the average directional index. The plus DM line measures how strongly the exchange rate moves long or up. This is the green line. The minus DM line, which is the red line, measures how strongly the exchange rate moves down or short. The line that is on top indicates the direction of the trend. So if the green line is above the red line, we have an uptrend. If the red line is above the green line, we have a downtrend. The bigger the distance between the red and the green line, the stronger the upwards or downwards movement. I can show you that with an example. Here, let's zoom in. You see that when the price spikes up here during the uptrend, it's moving up rapidly. The distance between the green and the red line is very big, and it shows us that we have a strong movement. However, when the green and the red line are close together, like here, they're scrambled, it means that the price is consolidating. The crossover between the two lines signifies a change in direction. As we see here, we have the green line crosses above the red line, and we have an uptrend starting, or an upwards movement during an uptrend starting. When the lines cross again, the green crosses here again the red line, it signifies that this upwards movement has stopped, and there might be a change in direction, or it lost strength. The blue ADX line, which is this line, shows the strength of the trend. It fluctuates between 1 and 100. The ADX indicator does not distinguish between uptrends or downtrends. It just shows how strong the price is moving towards a specific direction. So you can get your direction from the two lines, from the green and the red line, like I explained before, and see the strength of the movement by the blue indicator. The market is considered to be possibly trending or starting a trend above the 20 level. Let me mark this level for you, above this blue level. And it's considered to be trending quite strongly above the 50 level. The periods of the indicator determine how sensitive it is. Let me show you that with an example also. Let me first show you about the strength. You see that here that we have a sharp downwards movement. The indicator gets to a quite high value, like 43. However, here that it's not so sharp. It's around also around 40, around 33, and so on. Let me show you about the sensitivity. Now I have a 20 periods. The default value for this indicator is 14 periods, which is less. Now you're going to see that when I put it to 14 periods, it's going to become more sensitive. So now the indicator actually reaches to 50 level, and the previous level that was around 40, now it's again around 50. Now I'm going to show you the most typical ways of trading the directional movement system. The most popular way is to trade the crossover between the red and the green line. When the green line crosses the red line and goes above the red line, you trade long, like here. You're supposed to trade long. In the opposite side, when the red line crosses the green line, you're supposed to go short. Here is a failed signal, for example, that's a short signal. However, you're not supposed to trade randomly every one of the crosses, because you're going to see there are a lot of them, and you're going to be losing a lot of signals. So what's the point? The point is that during an uptrend that you must be confirming by seeing higher highs and higher lows on the chart, not just by looking at this indicator. You're supposed to be taking only the long signals, like this signal, then this signal, then this signal, and you're going to be successful because you're in an uptrend. The short signals, you should not be actually trading them short. You're supposed to be closing your long positions with them. So let me give you an example. Let's take this signal, for example. We have a buy limit here. Let's do a limit order so as to show you how your position would look like. This is the signal that I have traded now. The reason that I have traded is because we are on an uptrend. If we assume, let's assume that I only see this part of the chart. So let's hide the rest of the chart. So we are here. We have a possibility of an uptrend starting because we have a higher high than the previous one, then a higher low, then another higher high, then another higher low. So and here we're going to take the next signal. So we see another low has been done, so we're ready to take the cross. So we're going to trade this signal and we're going to go long. The next thing that we must do is put our stop loss. Don't forget about putting your stop loss. However, this indicator does not show you a correct place to put your stop loss. You can put your stop loss below the candlestick to be very, very conservative. This is very small stop loss, and you must be prepared to lose some trades, and you're going to finally catch one of them trade successfully. The less conservative way is to go below the previous swing, which is this is the previous swing. Go below the low of the previous swing. This is a very good stop loss, usually. Because if you're correct and this is an uptrend, you're going to get a target that gives you good risk to reward. And you can also go below the beginning of the downtrend to trade 1-to-1 or the least conservative stop loss. So let's put our stop loss here. Now that we place our stop loss, we also need to place our exit. This indicator also does not provide an exit in form of take profit, where to put our take profit, but we can exit. What the indicator does provide is two ways to exit your trade. One way is to exit on the opposite cross. So here we have entered long in this cross, and we can exit here in this cross. So see, we can exit here, and we're going to be successful. The other exit that the indicator provides is, you see this directional movement, this line, which measures the strength of the trend. I'm going to talk about this line in a bit. However, when this line makes a top, see here it went up and then it started going down and made the top. Then it's also a good exit. So you can exit here. It means that the strength is weakening of the trend. And of course, you can always use a risk to reward exit, so go 1-to-2 because you're trend trading. You can also use a lot other popular exiting the trend methods, like exiting on the smaller trend line. You can draw a smaller trend line here. When it's broken, you exit. You can make a channel in the trend, like this channel. Let me change the color. And exit when it reaches the channel, or you can go to a higher time frame and look for a resistance. The last way we can exit, and one of the ways that this indicator is useful, is divergence. Divergence is something used when we try to find momentum of a trend. So what divergence means is that even though the price has a specific slope, the indicator is showing the opposite slope. So for example, let's say that we don't have a take profit here and we're waiting for the divergence. We see here that the price is doing an upward slope. Let me color this line again to another line. Yeah, we have an upward slope here. However, on the indicator, since we are going long, we're going to see the green line, the plus line. See here, the slope is negative. See the difference? This means that we have a divergence. And here, at some point, we can exit because that means that the trend is weakening. So this is a great exit point. You see, in this case, the divergence is perfect. After the divergence, we will wait until the price returns to the moving average, like in this place, and we're going to start trading again. And we're going to get the next cross and do the same thing. The last way to trade the ADX is, let's remove everything besides ADX indicator. We're using the ADX indicator only. Remember when I said this indicator above 20, it means the trend possibility, below 20, no trend. So what some people do, especially in the robots, is that they are only trading trend strategies after the indicator is above the 20 level. So in these parts we trade trend, and in these parts we either don't trade at all or trade range. This is a very popular way of using the ADX. So I've shown you the most popular ways of using the directional movement system. I showed you all the signals, I showed you your stop loss and your take profits. Just remember, always be confirming with the price, having higher highs and higher lows on an uptrend, lower lows and lower highs on a downtrend. Don't be blindly taking all the signals that you see from the indicator. Now let's talk about the next trend indicator by Wells Wilder, which is called the parabolic SAR. SAR means stop and reverse. The indicator is very popular because, as I'm going to show you, it's very simple to understand how to use it. And also, it's very popular as a stop loss point. That means that even in traders who are not trading the indicator for getting trend signals, they often use it for stop loss, for placing the stop loss. I'm going to show you that in cTrader. The main concept of the parabolic SAR is pretty simple to explain. If the dots are below the candlestick, then you're supposed to go long. If the dots are above the candlesticks, then you're supposed to go short. You can change the sensitivity of the indicator by changing that mean AF parameter. It was 0.02. If we do it 0.05, you see that the indicator now became a lot more sensitive. And if we make it even smaller, like 0.01, it's going to be less sensitive. Now I'm going to tell you how to trade the parabolic stop and reverse. The entry signal for the parabolic SAR is supposed to be the change in direction of the dots. However, as I explained before in the ADX, the same rules apply here. If you try to enter anytime the dots change direction, then you're going to get a lot of failed signals and you're not going to be profitable. The whole point is to find that the trend exists by looking at the price action and getting only long signals. For example, here we have established that we have an uptrend because the price is doing higher highs and higher lows, so we can enter when the parabolic SAR changes direction, and we will be successful. However, if you take the opposite signals, we're not going to be successful, we're going to lose money. The exit signal for the parabolic SAR is the opposite change of direction compared to the direction that you're trading. So usually, you trade, you go long here, and when it changes direction, it goes above the candlesticks, you close your position. When I said that the indicator is used as a trailing stop, I mean that the traders place a stop loss where the dot is placed and move it automatically when the price moves. For example, if we enter here, this is let's do a limit order to show you again. So this is a signal. The indicator has changed direction at this candlestick here, the first, so we enter here. How the trailing stop works is we're going to put our first stop loss below the candlestick. So we enter at this candlestick, and the indicator is at this point. So we enter our stop loss at this point. Then every time the indicator plots another dot, we move our stop loss to the new dot. And this way it works greatly like a trailing stop, and our position is going to close here upwards. Another way is to just that the SAR is usually used. Traders just put the stop loss on the dot and they leave it there as a stop loss. And then for your exit, you can either go for the opposite exit, or you can use any of the exit ways you mentioned before, even a risk to reward ratio or breaking of the trend line, or all the ways that I explained before at the ADX. So that's it about the parabolic SAR indicator. I've showed you everything you need to know. It's a very simple indicator, a very simple concept. Just be careful to be establishing that you have a trend from the price action. The last indicator of Wells Wilder that we're going to talk today is the RSI, or Relative Strength Index. The relative strength index is maybe the most popular oscillator out there. An oscillator is an indicator that oscillates around a price. It has a maximum and minimum values, and it shows you, let's say that it flattens the price for you. So if you have an uptrend going up, the indicator is going to show the price movement going parallel instead of going up or down. Let's go to cTrader. I'm going to show you exactly how the RSI looks and what I mean with oscillators in general. So we go to the next chart here. We have a Euro USD chart, the same chart as before. Now I've plotted a relative strength index. As you see here from the RSI that I plotted in this window, the RSI has a minimum value of 0. It randomly reaches that value, however. A maximum value is 100, and it oscillates around the mid level, which is a level 50. The oscillators show if a price in the chart is overbought or oversold. Overbought means that in relation to the past data, the exchange rates has reached prices that are too high, or if a trend hasn't started, they're going to go down again. In the opposite is the oversold area, where it shows you that the prices have reached very low prices, and if we're not going to have a downtrend, they're going to go up again. We can see here with an example, when the indicator goes above the 70 level, the price is considered to be overbought. So it goes beyond the 70 level, so here at this point we can enter short, and we're going to win some money. The opposite thing here, this is oversold, we can enter long here, we're going to win some money. The typical levels to use on this indicator are the level 70 and the level 30. These are the levels that show if the indicator is overbought or oversold. Now I'm going to show you how to trade the RSI indicator. Then I'm going to talk about the blue lines, what they mean in a bit. The RSI is most usually traded successfully in a range market. It's a pretty straightforward. The first way to use the RSI is to enter when the price goes below 30, long, and enter short when the price goes above 70. You can, if you want, you can use your own levels. You can use 80 and 20. So, for example, use 80 here to get an even better price. But this is up to you. On ranges, you will get your level 80 on trends. I don't think so. So another way to trade it is not immediately enter when the price goes above this level, but wait for the price to go up and then cross this level again to enter short. So in this case, you'll see if we enter at this spot exactly, it's not the good entry point, but if we wait for the price here to go below the level again, it's a great entry point. The other thing you can do when entering in these levels is to combine this indicator with Japanese candlesticks or price action. We already did a video about that. You can go and check it out. When we combine this indicator with price action, we enter on like morning stars or hammers on things like that. Next is you should also be careful when where you're going to place your stop loss. This indicator doesn't give you any places to place your stop loss. So you should be using the popular trading methods, below the candlestick, below the previous swing, the typical stuff. The oscillator can also be used for trend trading. However, on a trend, because the price is moving rapidly, you have to use this indicator in a special way. The first thing that you must do is not get the signals that don't go with the direction of a trend. So if we have established an uptrend here using the price action, we're going to get only signals that are long. We're not going to get any short signals. And also another trick that you can do with the RSI, when you have a trend that is an established trend like this one, higher lows, higher highs, you can use the levels 35 and 65 instead of 70 and 30 because it's not going to reach the level 30 because when we have a trend, the price goes rapidly in a specific direction, and it doesn't, the oscillator, because of the way oscillators work, it's not going to reach level 30. I'm not going to explain why now we're using the formula. I'm just going to tell you, use the level 35 instead of 30, and you're going to get your signals. Like here, you see, and here we have another signal, and here we have another signal. It never reaches price 30 in a trend. The last popular way to trade the RSI is using divergence. RSI also is a very good indicator for divergence. So, for example, we see here that the price is moving up. It has let me show you the slope. It has a positive slope, but on the indicator, the price has a negative slope. We have again a divergence here, so this is a very good exit point. And you see, practically, it was a good exit point. So just to recap, on a range, you enter long and short, and you close. Oh yeah, I forgot to mention the exit. The indicator also provides good exits. You exit when the price goes on the opposite line. So if we enter short here, because of this signal of the 70 line, we're going to exit when the price crosses the 35 or 30 level here. To recap, when you use the RSI, if you're safely trading a range like here and you establish from the price that there are no lower lows and higher highs, you can enter both long and short from one line to another. If you have a trend, you can use a smaller level than the 30 on the 70, use 35 and 65, enter only with the direction of a trend, and you can close using any of the popular exit methods that I showed you before for the trend or when the price reaches the opposite line. In this video, we talked about 3 very popular indicators by Wells Wilder, and these indicators are also very popular generally. I would like to remind you, when doing technical analysis, try to keep it simple, don't overcomplicate it with indicators. All the analysis that I'm showing you is very simple. That doesn't mean it's not successful and it's not going to be good for you. In the next videos, we're going to talk about oscillators or maybe volatility indicators. If you like this video, don't forget to subscribe, and if you want, share it with your friends. Thanks for watching.